Joining us now is Prologis CEO Hamid Moghadam. Hamid, it's great to have you on the show. Thanks for being here.
Thank you, Morgan. Good to be here.
So a really strong report, and yet analysts pointing to a number of metrics, things like reduced global rent growth forecasts, lower lease proposals, occupancy decline, suggesting that there's signs of slowing in the market more broadly, and perhaps that's pressuring the stock. What do you think of that?
Well, I think our business has had the good fortune of being on steroids in the last 2 to 3 years, way beyond anything of in the normal range. And the business is moderating, as we've been talking about for a couple of quarters, but it's actually moderating at a slower pace than we thought. And if you look at it in the context of 30, 40 years that I've been doing this, it's probably in the top 10% of markets that we've operated in. So I think the market is getting too excited about virtually nothing.
Okay. I mean, we do have higher interest rates. I know you've made some acquisitions, including a deal recently with Blackstone as well. Why do you feel, if it is moderating, albeit at maybe a slower pace than you had previously anticipated, why do you feel confident to make more investments in this market right now?
Sure, because rents that are in industrial portfolios, for example, ours and the deal that we recently acquired, are 50 to 65% higher than what the rents are today. So rental growth and therefore earnings growth is not in any way dependent on marginal rental growth from here. Just capturing that upside will drive earnings into the foreseeable future at double-digit levels. So that's what the market is, I think, missing.
So, Hamid, I was struck by the net effective rent change that you guys talked about on your earnings call, up 87%, especially strong in Phoenix, up 137%, North Jersey, up 150%, Southern California, 181%. Why, in particularly those markets where it's strong, why is it up so much? How can those tenants afford to pay that much more?
Well, as I mentioned at the beginning of this conversation, the last 2 to 3 years have been exceptional in terms of demand for our product and therefore pricing of our product. At the same time, generally long-term supply in these really great markets is limited because nobody really wants warehouses built near them. And as a result, there are all kinds of moratoria and other difficulties in terms of bringing on supply. That demand has moderated. Of course, it would moderate. It can't go at double its normal level forever. And it had the embedded rental growth in this portfolio is not going to go away. And once we realize it, I think we will have substantially higher earnings as a result of that, particularly because of these markets.
A big part of your narrative also seems to be that the construction of new industrial property is going to slow down into 24, so there won't be so much supply on the market. That'll help keep prices higher. Are there particular markets where you see the build-out slowing particularly quickly?
I would say the supply is slowing down in pretty much every market that we operate in, very few exceptions. And last year there was a surge in supply because rents had gone up so much. But we know everything that's going to be delivered in 2024 because you would have had to have started the construction today. So we know with almost certainty what the supply is going to be in 2024. And we think it's going to be moderate and in the normal range. Let me also add that, most observers have been asking me about the year in which supply will finally exceed demand since 2011. And I'm not kidding you, since 2011. So, yes, it finally is going to happen in 2023, but I think it's a temporary pause in what is a very good fundamental picture long term.
I do want to talk about some of your other businesses that you're building out and diversifying with. The Essentials business, which is focused on solar production and storage. Prologis Mobility, which is the EV business as well. How are you thinking about the secular opportunities in something like green tech infrastructure? And what does that mean in terms of investments for the company?
Sure. First of all, we've been at the solar and energy game for about a decade. We're now the second largest producer of rooftop solar energy in the United States and expect to be number one by the end of this year. So this has been going on for some time, but the concept is actually pretty simple. We have other surfaces in addition to our floors to rent, our roofs, our sidewalls, and our parking areas where we can rent them in effect for EV charging. More and more of our customers are electrifying their fleets, and we have long-term relationships with them through our leases. So it's the perfect opportunity to supply them with all these products and services that they're going to need to buy from somebody else anyway, and we're in the best position to bring that to them because of our scale and our ability to do these things on a very economical basis.